But we've been talking about the broader market action, primary market action as well. Vijay Nirani, who's the managing director at TruAlt Bioenergy, joins in now. The company saw a steady listing, nearly 11% premium to its issue price, and now the stock holding up with a gain of almost 8.5% as well. Remember, they have about 3.5% market share in ethanol production for the country. What we'll ask them is the growth outlook for FY26, FY27, what they're targeting when it comes to market share, asset turnover on their new capex, and the third most important talking point, issues with feedstock availability as well, even as they have a fair amount of capacity. Thanks a lot for joining in, and congratulations. It's been a good show for all you guys on the bourses. The question is what happens from here on, because your issue was subscribed 72 times. There was obviously a lot of interest that was there on it, and what you're going to do with that interest and this responsibility that the street has placed on you is something that will determine where you go from here on as well. So it's a milestone, but the journey is still fairly long. And that's exactly the first question. You know, you've been growing well over the last couple of years. Do you think you can expect this rate to continue if you have put a range to it, Vijay? And the second part is in terms of market share. You have about 3.6% market share. With the new capacity coming on board, what's the kind of market share that you're eyeing over the next few years?
At the outset, thank you so much, sir. Thank you for having us here. This absolutely feels surreal. This is a journey of almost over 2 years now, and for TruAlt, 3 years. The kind of response that the capital markets and the country by large has given to us, it's only given a lot more of a motivation for us to work harder and keep building this company for the greater good. That said, just on the company, we just have about 3 years of history, and we've been growing at almost about 50-55% year on year. And the capacities to its peak, we've got 5 business verticals. First one is ethanol, where we've already infused capex to its rated full. That is at 20 lakh liters per day or 2,000 kiloliters per day. That gives us a potential of almost about 6 to 7% of the total country's demand. So, of course, the last year's market share was 3.6%. But the potential market share we have of the fragmented industry that is in the ethanol sector, we have about 6% of potential that we could deliver in the days to come using the capex, or rather the capacity that we've already built.
All right. So that implies near doubling of your revenue from here on.
So I wouldn't call it almost doublings. I would say we would hope to continue on the same trajectory that we have done in the last 3 years. This, I would say, based on the potential of the capacity that we've already infused. And also the other 2 verticals that we have that are set to come in by FY26 and few by FY27. That would be compressed biogas and sustainable aviation fuel.
Got it. All right. Hi, Vijay, and congratulations on the listing. Looking forward to chatting up more often. But we could see the smiles, they were quite wide as you all rang that bell. So good on you all. Let's get a few more details. Your current capacity utilization, I think, is around 45%. By when do you expect to hit, say that 70% odd mark, which is considered high utilization levels? Point number 1. Point number 2 is 100 days in terms of trade payables currently. You had planned to reduce it, I think, to around 52. By when would that happen?
Thank you so much for that. Yes, it is a little, it's unimaginable. We're still pinching ourselves to see the reaction. So that said, on the first part of the question, on the capacity utilization, if you read the note on the RHP, we do mention that we have been building the capacity over the last 3 years. That is, in FY23, we had a capacity of around 590 kiloliters per day. In FY24, that capacity increased to 1,400 kiloliters per day in the last quarter of that financial year. And in FY25, the capacity again jumped to 2,000 kiloliters per day, where 1,800 was put to use. So when they calculate the capacity use, they are doing the calculation based on the entire gross, the installed capacity. And when we do it based on the gross capacity on a 300-day basis, we see a lower capacity utilization. Whereas now that we've got the whole capacity at play, we should see at least 6. In fact, we are estimating a 60 to 70% of a conservative capacity use for the year to come, and from there on to jump to 90% from there. That's from FY27 onwards. So that's the expectation we carry.
And the payable days?
And the payable days, however, it is, if you compare it with the industry, we have a better payable days as compared to the peers. Of course, here there's not an apple-to-apple comparison with peers. However, so far we used to have a lot of transactions with the promoter group company where we got this leverage. Now, the reason for us to go public was also to create a working capital corpus so that we could build on our inventory at the cheapest raw material. The price of raw material is very dynamic in our case. And the business largely is at what price we buy the raw material so that we keep focus on the bottom line and keep increasing the bottom line. So when it comes to the payable days, we will be building on inventory. We will be having a lesser payable days thanks to the proceeds of the IPO, wherein we are building close to about 425 to 450 crores of corpus that will go straight as working capital requirements.
All right, we take that point. Thank you so much, for explaining that to us. And also, you said that you've been pinching yourselves. Good, you've been pinching yourselves. If you pinch each other, then that'll become violence. And secondly, what you don't need to do for sure is pinch the shareholders. And the shareholders, what they really want to know is that what are the kind of margin levers that you have from here? You said that raw material prices are fairly dynamic, fairly volatile. But I'm looking at, some of the raw materials that you source. And the availability is always an issue. So what is it that you're doing to, make the availability consistent at a predictable price, and basis your increased capacity utilization and everything else that you're doing, what would the margin impact of that be? Could we see them move towards 17, 18, 19%?
So two parts to this. So the opportunity that the biofuel story, or rather let's begin with the ethanol story, carries is we've got 5-6 different prices. Ethanol from syrup has 65 rupees a litre. Ethanol from maize has 71 rupees a litre. From rice has 64 rupees a litre. So there are about 5 different prices that is there. And the OMCs pick the quantities at that range. Now, we have got out of the 3, raw material price, cost of conversion and the selling price. Our selling price is already fixed. So we don't have to worry at what price I'm going to sell. Then comes on the floor level, the efficiency or the cost of conversion. We are at almost peak levels of stabilization, or rather best efficiency, because we are actually utilizing the gas that comes out, the CO2 that comes out, we are bottling and selling. The spent-was that comes out will be diverted to the compressed biogas plants as additional revenue. So it is as dated as possible. So that leaves us to build a bottom line or margins on the price of the raw material in itself. So just to give an indication, or rather what we see, the commodity price trends, that is rice or maize or sugarcane, molasses for that matter, not the sugarcane in itself, but the molasses for that matter. The delta in the price from the lower ceiling, the lower brackets to the higher bracket is as high as sometimes between 20 to 25%. And we end up achieving this 15-16% of EBITDA on the fairly median on the higher brackets of the EBITDA. So this is what, and that's the structure of how the government usually prices the price of ethanol or the raw material.
So by and large,
the idea largely will be to buy the raw material when it is cheapest.
Got it. So by and large, this 15-16% is sustainable. On extreme cases, it can go to 20-25%. But, what analysts should usually pencil in is a 15-16%.
I wouldn't. No, I wouldn't consider it at 20-25%. It could, that's the delta of the raw material prices. So I would only say the EBITDA would hover between 15 to 16-17% if we play our cards right.
All right, that's fairly indicative. Thank you so much for joining in. Once again, congratulations on the listing. We will keep having conversations with you quarterly post you give out your numbers. With that,